Hi there, it's Carlo Leone again. Welcome and thank you for joining me today. So first of all, today we will be discussing journals. Well, not all the journals. We will be looking at your cash book payments, your cash book receipts, as well as your petty cash. But now before we start with the journals, we need to know that part of your journals will be VAT calculations. Now I know I've already spoken about the VAT calculations in one of my previous lessons, but we also need to know that there are certain VAT categories, so I just want to quickly talk about them before we get to the journals. Alright, now first of all, you get your standard rated supplies. Now like I said before, you can only claim VAT if you are a registered VAT vendor, and you can only claim VAT back if you purchase from a registered VAT vendor. Alright, so first of all, you get your standard rated supplies. Now most of your stuff that you will be purchasing as a registered VAT vendor, you will be able to claim VAT back from it. So that's anything that is necessary for you to operate your business, like your computer, like your computer software, like the stock that you are using, anything that you need to run your business, that will be a standard rated supply and you will be able to claim that VAT back. That will include your electricity, your telecom, your internet, all that stuff will be standard rated. But you do get certain items that are zero rated. Now when an item is zero rated, you will not be able to claim that back. And so you will need to know which items are zero rated that you will not be able to claim. So zero rated supplies is, I'm just going to read a few items here, is like your petrol, diesel, paraffin, certain foodstuffs like I know in South Africa, brown bread, milk, fruit and vegetables, pilchards, certain foodstuffs that are zero rated. Then exports, only where I'm just reading it, only exports where your business is liable for the delivery cost of the goods, the sale of a business as a going concern, and any services rendered by a welfare society. So these things you just need to know, because you will need to know this stuff when you do your journals, that you do not accidentally claim VAT from it. You also get exempt supplies, which is items like your life insurance, interest received or interest paid, renting a dwelling for use as a private residence, passenger transport, or donated goods donated by a non-profit organization. And then your non-allowable items, which is entertainment. Now what entertainment expenditure means, sorry about that, is if you take clients out for a meal, or you cannot claim that back. And now why can't you claim that back? Because this has got to do with my business. So why cannot claim it back? Because you can take your family out for a meal and tell SARS that you took clients out. So fraud can happen in a circumstance like that. So therefore they made that a non-allowable item. Then also passenger vehicles. You cannot go buy yourself a nice Maserati or a Porsche and say, no, you need that for your business. Certain vehicles will be allowed to claim VAT back, but that's like if you're in farming and you need a bakkie, not a double cab bakkie, because they see that as a luxury vehicle. So if you buy a normal bakkie, you'll be able to claim that type of VAT back. So passenger vehicles, and then club fees and subscriptions. Unless you need to belong to a professional body, like if you belong to a professional body as an accountant or a bookkeeper, that will be tax deductible. The doctors need to belong to the medical society or the medical something, and because it's part of their work, they cannot operate unless they are registered with that body. That will be, but to allow your staff to belong to a golf club or anything like that, that is not necessary for the work. So stuff like that will not be allowed to claim VAT back. So I just quickly went through it. And so just go through it in your textbook. Your lecturer will possibly also give you a few more items that you can add to the zero rated, exempt or non-allowable items. So just learn them off by heart, but also you need to know them when you do your journals, that you don't accidentally claim VAT for items which are non-allowed. Alright, so now let's get to the fun part first. Just want to see that I've got the right marker here. Okay, now first of all, we have 7 different journals. We have your cash book receipts, your cash book payments, your petty cash journal, your debtors journal, your debtors allowance journal, your creditors journal, your creditors allowance journal, and your general journal. 1, 2, 3, 4, 5, 6, 7, 8. Sorry, we've got 8 journals. My apologies. Cash book receipt, cash book payments, petty cash journal, debtors allowance journal, creditors allowance journal, and then your general journal. So now, when you're busy with the journals, you're going to have certain transactions, and you need to figure out which transactions go into which book or into which journal. So an easy way to do this is to remember the following. Okay, you have got 4 main accounts. The one is bank, the other one is your debtors, the other one will be creditors, now debtors control, creditors control, and the other one will be your petty cash. Now bank, we should already know, is an asset, which is increases on the debit side, decreases on the credit side. Debtors is also an asset, same story. Creditors is a liability, so decreases on the debit side, increases on the credit side. And then petty cash is an asset, so plus minus there. So when you do your transactions and you work it into your accounting equation, you need to remember, whenever something increases your bank, it's your cash book receipts journal. Whenever anything decreases your bank, it's your cash book payments. Whenever anything increases your debtors, it's your debtors journal. And whenever it decreases your debtors, it's your debtors allowance journal. Now we go to the creditors. Whenever something increases your creditors, that'll be your creditors journal, and whenever it decreases your creditors, that will go into your creditors allowance journal. And then whatever decreases your petty cash will go into your petty cash journal, and then anything else goes into your general journal. Journal. Alright, so let's see, those are 2, 4, 6, 8 journals, so I covered all of them. So let's just go through that again. So you do your transactions, and once again we will be doing an example and where we will explain how all of this comes together, as always. So once again, whatever increases your bank, cash book receipts, decreases it, cash book payments. Increases your debtors journal, and then debtors allowance journal. If it increases it, the debtors journal. Decreases it, debtors allowance journal. If it increases your creditors, it goes into your creditors journal, and it decreases creditors allowance journal. Whenever it decreases your petty cash journal, and then anything else will go into your general journal. Okay, but like I said earlier, today we will be looking only at your cash book receipts, your cash book payments, as well as your petty cash. Okay. Now we forward. Okay, let me just wipe here. just going to draw it small here that we can remember it. So we've got bank and petty cash. Assets plus minus, asset plus minus, and then whatever increases, so that is your cash book receipts, decreases it, cash book payments, and that goes into your petty cash journal. Okay, so is that understood? Now one thing I do realize that on this camera you are not going to see what I write here. I just made A3 copies of the 3 journals that we will be doing today, and I know that you will not be able to see that. So it will be good for this exercise. Well, obviously if you are a student, an ICB South Africa student, you will have this example in Learning Module 3 in your textbook, and you can just follow what I'm doing here. If you are not an ICB student, I would advise you just to get a template of the cash book receipts, cash book payments, and the petty cash journal, just to get that in front of you, and then as I talk about this, just write it in so that you are able to follow what we are busy discussing here. So first of all, let's go and look at the cash book receipts. Now, first of all, let's go read what they say. First, they talk about Leroy Ungaretti, who's the sole trader, and he's got this company called Letsema Furnitures. They've got a constant markup of 50% on cost. Okay, now if you remember 50% on cost. Now, if you remember what we did in the previous, in one of the previous lessons, that's the magic block. This is very important. Remember, 50% on cost, you work with your markup percentage. If it said 50% on your sales, you would have worked with your gross margin. So if you haven't watched that video before, just go back before you start this, that you can see how the magic block works and how you calculate your markup percentage and your gross margin percentage. Alright, so they do tell us it's 50% on cost. So for that reason, we know we're going to work with markup percentage. And I'm going to say again, if it said 50% on your sales, that would have been gross margin percentage. Okay, so that is the most important details that we need to get from the introduction. So first of all, you've got your cash book receipts. I just want to get another pen. Your cash book receipts of Letsema Furnitures for March, and then here in the corner you write your cash CBR 1. That's just an indication that this is your cash book receipts 1. Now how do you know which one is number 1, 2, 3 or 4? It's very simple. Depending on when your financial year end is, I know in South Africa it's February. So now the month after that is March, which will be the first month of the new financial year. So March, so this is Letsema Furnitures for the month of March for whatever year. Cash book receipts 1, because last month, February, was month end. Not month end, was the financial year end. So April will be cash book receipts 2, and so on and so on. So you've got your cash book receipts of Letsema Furnitures for March of this year, cash book receipts 1. And now you've got all these blank spots here that you need to fill in. Now first of all, it's your document number, your day, the details, your folio. Now the cash book receipts has got your analysis of receipts, your bank, VAT. Now you need to indicate whether that's VAT input or VAT output. Sorry, we will look at that now. So it's bank, it's VAT, services rendered, sales, sundry accounts, your sundry accounts, which is your amount, your folio, your details. And then over here we've got cost of sales. But remember what we did previously, cost of sales does not stand alone. It goes together with your trading inventory. Now that you only fill in once when you've completed a sale. Okay, so it's document number, day, details, folio, analysis of receipts, bank, VAT, services rendered, sales, amount, folio details of the sundry accounts, cost of sales, and trading inventory. That'll be in the little block right to your right. Okay. So now first of all, we need, another thing of what I said, is you need to indicate whether something is VAT input or VAT output. Now if you remember what I said in the previous lessons, I said whenever money goes out, it's VAT input, and whenever money comes in, it's VAT output. So let's see, what book are we working with now? We're working with cash book receipts. So in other words, money is coming in, we are receiving money, so that'll be VAT output. Alright, now let's go look at the cash book payments. Once again, it's the same thing. Cash book payments of Letsema Furnitures for the month of March. Cash book payments 1, and then you fill in your headings, and that'll be your document number, your day, your name of payee. So in other words, in the cash book payments, you need to remember, you write the name of the person you are paying. Folio, bank, VAT again, we're going to see now if it's VAT input or VAT output, trading inventory, and then your sundry accounts, amount, folio, and details. Now first of all, let's go and see, is it VAT input or VAT output? So in other words, cash book payments, so we are paying money out, money is leaving the business, so when money goes out, it's VAT input. So let's just put that in, VAT input. Alright. And then last but not least, the petty cash journal, same story, petty cash journal 1. Then you have your document number, your day, your details. Now remember, in the petty cash journal, you don't write the person's name or you are paying or something. You must write in there the items which you purchased through petty cash. Okay, so don't forget that, but in the exercise we will take that a bit further. So document number, day, details, petty cash, postage and stationery, staff refreshments, and once again, now it's VAT. So does money go out? Petty cash, you buy stuff, so money goes out, so that'll be VAT input. And then once again, your sundry accounts. Now, I know one of the questions you can ask me is, why are only certain amounts here, and then you have your sundry accounts? Okay. Now that all depends on your business. Now usually the accounts which you use the most in a month will be the ones that will be to the left of the sundry accounts. Why is it? Because if you've got 100 or 1,000 transactions in a specific account, you don't want to transfer every single little account to your general ledger. You will want to add it up and only take the total. Where your sundry accounts are accounts that you don't always use. Well, you do use them, well, always, most of the months, but they don't. You don't use them that much in a month. So as you can see, so the sundry accounts will just be separate. So that's like if you pay a telephone bill once a month. I mean, you're not going to want heading, a whole line of accounts for something that you're only going to use once a month. And something else we need to see from the journals is, as we can see, I said we had 4 main accounts. Now your main accounts, remember your main accounts is bank, debtors, creditors, petty cash. Now those accounts, you must realize, is always VAT inclusive. Alright, so you need to know, so your bank account in your cash book receipts and your bank account in your cash book payments, they are the VAT inclusive amount, and then the other accounts, you obviously deduct your VAT from that, so the other account will be your VAT exclusive amount. So do not forget that. And also, if you add up all the items on your left, on your right to the bank. Sorry, I'm getting really tongue-tied here today. My apologies for that. But if you add up your account plus your VAT, that must be equal to your bank. But we're going to be doing that as well. We will be doing an example of that. And like I also said previously, if you have got some questions with regards to this stuff, there is an email address on the description of this video on YouTube, so you're welcome to email me if something is not clear. Thank you for the emails that has coming through. I'm glad to see that I am actually helping somebody there, so thank you for that. Alright, so now we're going to start with the real fun stuff. Okay, and I've got a whole lot of notes here, so if I do disappear sometimes there, I just need to ensure that I've got all my notes and everything correct. But so we will be looking at that. Now this lecture might take a little bit longer to complete. It's quite a long exercise. It's quite a long exercise, so I might have to do it in 2 parts since I can only record up to an hour at a time. So my apologies for that as well, but I will be completing both of the parts today, so it should be on YouTube not too long. All right. So first of all, we've got everything. So let's get started. So first of all, let's look at transaction number 1. Now it says Leroy issued a personal check for 100,000 as a capital contribution. Receipt number RC01 was issued and the duplicate was retained. Alright, so first of all, now we're going to once again draw out T accounts. Now, as you can see, I've got limited space, so I will not be able to keep all the T accounts, so I'm going to wipe them as I do them. But if you can, just draw these T accounts and have them next to you as we do this stuff. Alright, so first of all, let's see what happened. Okay, sorry, just want to get my notes here. So first of all, Leroy issued a personal check. So in other words, check, what did we say was that? That's always bank, which is an asset plus minus. And what happened? He gave it as a capital contribution. Now capital is an equity minus plus. Alright. So what happened to your bank? Your bank increased with 100,000. Am I right? And then your capital increased with 100,000. All right. So that's simple. That's simple to see. So now we go back and see. Okay, what did we say is going to happen? Whatever increases your bank goes into your cash book receipts. So let's quickly do that. Okay, and just something I forgot to say, the analysis in your cash book receipts, you've got an analysis of receipts column. Now everything, well, most of the stuff that gets inserted in the cash book receipts will end up in the analysis of receipts, and you only transfer it once you've banked that specific money. So if anything goes into your bank automatically, it will not show on the analysis of receipts column, but it will only show on the bank. But if it's money that your business received, cash money that you've received, that will first go into the analysis of receipts column, and only once you've gone to the bank physically and you've got a bank deposit slip that you've deposited that money, then the total will be written in the bank column. Okay, but I will explain I will explain that once we get there. So first of all, so now we've got, okay, the receipt they say in the book was RC01, so document number is RC01. The day was the 1st. Now the details we just put the owner's name, which is Mr. Leroy Ungaretti. Okay, now will this one come into the analysis of receipts? It said he issued a personal check for 100,000 as a capital contribution. So in other words, it didn't directly go into the bank account. So yes, it will go into the analysis of receipts. It's 100,000 into the analysis of receipts. Okay, let's just continue. Now we have to search and see, is there an account for capital? As you can see, the other account is capital. So no, we've got the VAT. We cannot claim VAT from that. Okay, because it's a capital contribution. It's a cash contribution, so you cannot claim VAT back from that. It wasn't for services rendered, it wasn't for sales, so since it doesn't fall under those categories, it will go into sundry accounts. Now the sundry accounts, then amount is 100,000. Details will be capital, because it's the other account. Now this folio, you will see there that there's a thing marked folio. Now those are numbers, or certain numbers that your company will give each and every account. Now, where did I put mine? Oh, okay, now I cannot remember. Okay, but anyway, so how that will work is, you will see from your trial balance from the previous month, each and every account has got a certain number. It will either be an N or a B number, an N number or a B number. So the B stands for your balance sheet accounts, and your balance sheet accounts will be your assets, your liabilities, your capital, and your drawings. So all those will have a B number attached to them. Your N numbers is your nominal accounts. It's your nominal accounts, and your nominal accounts are your income and your expense accounts. Okay, so you will also learn, but the numbers should be on the previous trial balance, because those numbers just follow from month to month. It doesn't change at all. So the number that we have for capital is B1. Okay, so obviously your balance sheet account, like I said, assets, liabilities, capital, and your drawings. And then your nominal numbers will be your income and your expense accounts. Okay, if I am talking all over the place, I know it's a lot to remember, but that's one thing that bookkeeping and accounting is. You need to try and follow everything. So if you've got any questions, please just email me. Alright, so let's look at the next one. So the next one is, you cashed the first business check for petty cash 2,000 Rand, and this was regarded as the impressed amount. So in other words, you're opening your account with your petty cash with 2,000 Rand. So once again, let's look at our T accounts. So first of all, it said you cashed the first business check, so once again it's bank. So assets plus minus, and then your petty cash. Also assets plus minus. Okay, so number one, now your bank decreased. What happened? Because you cashed, money went out towards your petty cash, so your bank decreased with 2,000 Rand. Your petty cash increased with 2,000 Rand. So what did we say? We said what happened if your cash decreased or your bank decreased? You go into cash book payments. So let's quickly fill in your cash book payments. So first of all, document number 1, that'll be for petty cash. Let's just number it 01 if they don't give you a number. The date will be the 1st. Name of payee. Remember they said they cashed the check, so that'll be, the name of payee will be cash. your bank will your bank has decreased with 2,000 rand. Okay, no VAT is claimable because you just cashed a check, nothing was purchased, and no VAT is claimable. Trading inventory, you didn't buy anything or receive anything. So let's see. So in other words, it will go into your Sundry Accounts, which will be amount 2,000. The folio for that account, let me just check here, will be B8, and that will be petty cash. Because that's your other leg. Are we happy with that? I hope so. Yeah, B8. I'm right there. Okay. Now let's look at number 3. Sorry. Okay, now we say the business received 150,000 in the form of a loan from AAA Bank to be used as additional funds to buy inventory. The money was transferred directly into your bank account. Okay, so let's do that one quickly. You always go back to your T accounts. So first of all, let's see what happens. So the business received 150,000 rand. It went into the bank account. So what happened? We've got bank, assets, plus minus, and then it's from a loan from AAA Bank. That's a liability minus plus. Okay, so our bank increased with 150,000, but so did our liabilities increase with 150,000. So once again, we cannot claim that back because it's just a loan. The bank didn't claim back for that, so we cannot claim that back on that amount, only once it's been used for whatever. Okay, so let's have a look. So our bank increased. When our bank increased, it goes into our cash book receipts. So now obviously this money went straight into our bank account, so that will only appear on our bank statement. So your document number will be bank statement, the date is the 2nd, it is from AAA Bank, that's the details. Then it went straight into our bank account, straight into the bank account. So in other words, it's not going to appear in the analysis of receipts column, but it will straight in the bank account. So let's put it there, 150,000. Cannot, like I said before, we cannot claim that back. It wasn't for services rendered, it wasn't for sales. So that will go into the Sundry Accounts, which is 150,000. And it's a loan, and the other account is loan from AAA Bank. Alright, okay, so document number, bank statement, the day is the 2nd, details is AAA Bank, bank 150,000. And then in your Sundry Accounts, 150,000 for your loan from AAA Bank. Okay. Then let's see. How's my time doing? I'm doing good. Alright. Then it says we purchased furniture for resale. Okay. So let's see now. Purchased furniture for resale. So now we've got 3. So first of all, let's look. Purchased furniture for resale purposes from Pecanut wholesalers and paid by check. So once again, our one leg will be bank, which is an asset plus minus. Now what did we buy? They bought furniture for resale purchases or purposes, so that'll be your trading inventory, which is your assets plus minus. And then obviously because we bought something, we bought it from a VAT vendor, and that means we can claim back that VAT, so that'll be your VAT. We're going to see now if it's VAT input or VAT output. So first of all, let's have a look. So what happened? We paid by check. So our bank decreased with 80,000. Okay, and now because we are working with VAT, now we need to calculate the VAT exclusive amount. So first of all, and remember what we said, your main account is always the VAT inclusive amount. So you take your 80,000 divided by 1.14, then you get your VAT exclusive, your VAT exclusive amount. So your trading inventory increased with 70175.44 because it's 438, so we just round it off. And now what we see, bank, when your bank decreases, that means money went out, so that will be VAT input. And you can also see it corresponds with your cash book payments, which is VAT input. So your VAT amount then will be 80,000 minus that. So your VAT amount then is VAT input is an asset plus minus, and then that will be 9 on your debit side, 9824.56. 9824.56. Alright. So now we need to see one thing. Remember what I said previously. Your debits must always equal your credits. So we've got two debits here. That debit plus that debit gives you that credit. So your debits are equal to your credits. But now we need to transfer this back into our journals. So first of all, our bank decreased cash book payments. So that goes into the cash book payment. So let's have a look. Let's have a look. Okay. So this will be number, where are we now? Cash book payment, yeah. So that'll be document number, will be document number 2. The day will be the 2nd. Okay, name of payee, who did we buy this from? We bought it from Pecan Nut Wholesalers. Now, Pecan Nut Wholesalers, then the VAT inclusive amount is 80,000. Now the VAT input, as we calculated there, is 9824.56, and then the other leg is trading inventory. Now we do have an account there for trading inventory, so this does not go into the Sundry Accounts, and that amount then is 70175.44. And remember what I said, everything on this side of the bank, of the bank account, if you add those together, it must give you your main account. Are we happy with that? I hope so. Okay, so let's do the next one. I hope you're writing all of this down. It will just make it easier to follow. Okay, so let's have a look. What's number? Okay, so we've done that one, done that one, and we've done that one. So let's look at the next one. Okay, services rendered, installation fee only for 10 sets of kitchen cupboards in a townhouse complex. Issued cash invoice CV1 for this purpose, 11,400 inclusive of VAT, on receipt of the check from the customer ED Developments. Okay, so let's just draw our T accounts again. 1, 2, 3. Okay, so first of all, let's have a look. It says services rendered, issued a cash invoice. In other words, they paid by cash. So that'll be bank. So assets plus minus. Then what was it for? It was for services rendered. That's an equity minus plus, and then it's VAT because it was money came in. We did a service for them. They paid us. Money came in, so that'll be VAT output. VAT output is a liability minus plus. Yes, that's it. Okay. So we did it. So what happened? First of all, they say 11,400. Our bank increased with 11,400. So now we need to calculate the VAT again, or the VAT exclusive amount is 11,400 divided by 1.14 gives us services rendered. It's an income. Remember, an income is always a credit. So that'll be 10,000. And then our VAT input will be 11,400 minus 10,000, and that'll give you 1,400. And once again, please observe your credits. You add your credits, it's equal to your debits. Okay, be good there. Excellent. Let's carry on. So now we see our bank increase, so that'll go into your cash book receipts. So let's have a look. So, sorry, I just want to see your cash invoice CV1. So cash book receipts CV1. The date was the 4th. Details is services rendered. Analysis of receipt. They didn't pay directly to our bank account. So bank or analysis of receipts is 11,400. We're not going to touch the bank account yet. We will do the bank account after we've done all the exercises. Alright, so the VAT output amount is 1,400. And then we do have an account for services rendered, so that'll be 10,000. Alright, okay, I just want to mark all the ones we've done before I get confused. Sorry about that. Alright, well, we're not doing too badly today. I'm very glad about that. Okay, so now we've done that one. Okay, let's look at the next one. This is going to take a while because this is a whole exercise I'm going to do with you. And like I say, I hope you all are all ICB students, that you can just follow it in your book. But yeah, if you're not, hope you're keeping up. Okay, so let's look at the next one. Made an electronic fund transfer. Okay, let me just do this again. Here, because we're working with VAT now, there will be 3 accounts. So you made an electronic fund transfer, EFT, that's out of your bank. Assets plus minus. Okay, let me first read. Sorry, I'm actually going ahead of myself here. You made an electronic fund transfer for 1,240 in favor of Belcom for the installation of the business ADSL line. Okay. So that'll fall under your telephone account. So your bank is the one account. The other account will be your telephone, which will be your equity minus plus, and then once again VAT. So let's see what happened now. You made an EFT, so money left the business, money went out, so that'll be VAT input. VAT input is an asset, bank is an asset, and then your telephone. So your bank decreased with 1,240. Then remember, all your expenses are debits. All your expenses are debits, all your income are credits. So in other words, telephone gets debited with the VAT exclusive amount. So that'll be 1,240 divided by 1,244. I'm not going to I'm not going to calculate all of that, otherwise it's going to take too long. So that'll be 1087.72, and VAT input is always a debit, so that'll be the 1240 minus 1087.72, and that will give you 152.28. So now once again, now we simply transfer that into your journals. Let me get my pen. So bank decreased, so that'll be in your cash book payments. And we did an EFT, so your document number will be EFT. The date that we've done that was the 4th. Who did we pay? It was Belcom. And now let's see, bank 1240, your VAT 152.28, and then there isn't an account for telephone, so that'll go into your Sundry Accounts, amount of 1087.72. Okay. And it's a nominal, it's an expense account, equity expense. So that'll be a nominal account, so that is N5, and the account's name is telephone. Great stuff. So now we've done that one. Just want to mark these off. Sorry about that. Okay, we're doing good. I think we're going to do one more, then I'll have to stop, but then I will be recording part 2 of this exercise. Okay, so we've done that one. Alright, now, purchase stamps from petty cash, 48.50 inclusive of VAT. Petty cash voucher PV1 was issued. Alright, so let's just wipe. I'm just going to wipe it and draw them from scratch. Faster, I hope. Alright, so first of all, petty cash. So now we've got petty cash. Okay, what did we buy? We bought stamps. I just want to confirm something quickly. Petty cash. Now stamps will fall under the account postage and stationery. So postage and stationery, so petty cash is an asset plus minus. Postage and stationery is an expense, so that'll be equity. And then once again VAT, so it's petty cash, money went out, so it's VAT input, which is an asset plus minus. Am I right? I better be. Okay, so your petty cash decreases with 48.50. Your postage and stationery will be your VAT exclusive amount, 48.50 divided by 1.14, and that will be 42.54, and your VAT input amount will be 5.96. So now let's do it. Now once again, petty cash decreases, so that goes into your petty cash journal. So let's quickly have a look at this one. Petty cash journal. Here we go. Document number. Does it give us one? Yeah, PV1. Okay, the date is the 5th. What did we buy? We bought stamps. Remember, the items that you purchase go into your details. So we purchased stamps. So your petty cash decreased with 48.50. Postage and stationery 42.54. And then your VAT 5.96. So I want to check my time. And we've done that one. We've done that one, and we've done that one. Okay. Excellent. I'm going to have to stop it here for now, but please, I will be doing part 2 of this, where we will be continuing this exercise in a few moments. Thank you very much.